Well, hello and welcome back, everybody. This is our second to last whole housing market update of the year. We're going to have one more in 2 weeks before the end of the year. But I think now is a really interesting time of reflection, and there's a lot of news out there. And one of the things I want to talk about a little bit is kind of some of the smoke and mirrors of the housing market. And before we kind of launch into our stats, which we're going to have our own fun discussion, there's actually one chart on here that does concern me quite a bit. So that'll be fun. So definitely don't tune out for that because I do have something I want to tell you about there. But one of the funny things about housing is that people are interested in housing. And that means people talk about housing, people speculate about housing, people do a lot of different things on housing. And from doing things that are clickbait to being doomsayers to also being people that ignore very obvious warning signs. So there's kind of a lot going on. And that's not even talking about the psychological aspects, right? A home is probably the biggest asset for most people. So, in order to, there's a lot of sensitivity around that. But I want to talk about where we are towards the end of the year. We've got some interesting macroeconomic effects, right? We're seeing unemployment tick up. We're seeing a lot of people say that they're struggling. Are they actually struggling? I think is an interesting question. Or are they struggling in the numbers that it seems like they are? And do some of these thoughts end up becoming self-fulfilling prophecies economically? So let's go ahead, let's get started, and let's get into it. My name is Stephen Meade with Domicile real estate for people who love houses. This is our whole market, Southern California housing market update. We use data from Los Angeles and Orange counties. I'm going to go ahead and jump right into our slides because I think there's kind of some interesting anecdotes to kind of go along with some of these slides. So let me bring those up and I will tell you what I am talking about. Okay, so the first thing is just talking about where we are in the market in terms of total active listings. And the reality is we are not that much higher than we were at last year. Where they're talking about under $1 million homes, whether you're talking about homes in that $1 to $2 million range. Is inventory higher? Yes. Is it that much higher? Not really. And in the grand scheme of where are we normally, is this a lot of inventory? It's actually really not a lot of inventory. Now, if you're a home buyer out there and you have the feeling that you're looking at a bunch of junk that you don't want to buy, this may be especially acute for you. This is the chart that really kind of gives me a sense of pause, right? And I think there's a lot of clues hidden within this chart that we need to talk about. And obviously, what I'm speaking about the most is you'll notice there's a general trend of what happens through the year. We have inventory that basically starting the beginning of the year tends to rise up as new inventory hits the market, kind of crests somewhere in that June timeframe, and then it slowly starts dropping towards the end of the year, accelerating at the very end. But I want to show you something over here on the right side of this graph. And that is if you take a look and you see this bounce in inventory in both price categories, right? Not just under $1 million, but also 1 to 2 million. You see this bounce of new listings hitting the market. Now, if you look back last year, we did see a similar bounce, but it occurred almost a month later. I wonder, and what gives me a little sense of anxiety is this an indication of anxious sellers who want to try to be on the market by the end of the year? Traditionally, not exactly a time that sellers are rushing to put their homes on the market. I went into an open house this weekend that still had a dumpster out front from renovations. There were still contractors during the open house. That is how anxious this seller was to get their home on the market. And I thought that was particularly interesting and noteworthy. So is this for sure what's going on? Not necessarily, but it's definitely something that's kind of raised my eyebrows a little bit, and I wanted to make you aware of it too. Now, if we look at our new escrows, there is some good news on this front. We actually see a commensurate little bounce. Now, is part of that possibly as a result of interest rates? By the way, for those keeping track, I got an email just today from a very large mortgage lender. They are doing 7-1 jumbo arms. That means it's fixed for 7 years at 5.125%, right? So to say there's no low rates out there, that's not true. There are absolutely low interest rates out there. That might explain a little bit of this bump, but I mean, this is a real course reversal if you look at this, right? I mean, just really kind of a dramatic turn, and it's happening earlier than it normally would. So I'm kind of curious why that is and what that might mean in our marketplace. Now, if you look at our absorption rate, I mean, here's some good news, right? Like, did it rise through the fall? Yes, which is, again, a little unusual. And we did hit almost 90% 2 weeks ago. And now here we are, in that 80% level. That's still a pretty healthy market, right? That means if you've got a home that is well priced and attractive, right? Like someone is kind of hitting right in the mark where the market is in terms of their price, you're going to see a relatively quick sale, right? Like we're seeing that supply demand balance is not too far off. If you look at our closed prices, we've got some aberrations here due to a small sample size because of the way we run our stats with Thanksgiving. But I want you to notice some interesting trends here, right? What we're seeing is a little bit of compression, at least between the median and the higher priced homes. I mean, if you look at that 75th percentile, that's really been on a steady low decline all year long, whereas we pretty much got things maybe either the same at the very bottom end for our 25th percentile or a little bit higher on our median. I think it's interesting we're seeing that market compress together a little bit. And I think a lot of that is a result of economic uncertainty, right? I think there are a lot of people unsure. Are we on the precipice of a bunch of layoffs and raising unemployment? Are we going to see AI taking jobs? I think there's a lot of governmental uncertainty about policies, tariffs, and I think really some of that stuff is finally coming to roost. Businesses and by proxy, well-paid employees of businesses or business owners are a little bit reticent on making housing moves, right? Like that's a very big financial move to buy or sell a property. Now, if we look at our percent still active after 14 days on the market, we actually see this showing a little bit more competitiveness in our marketplace, right? Like we saw this number rise kind of towards the middle of the year, and then it's been maybe trickling downward. And when this number goes down, what it means is that more of that fresh inventory is getting picked off sooner in the process. If we look at our close to list ratio, this is actually heading back towards 100%. What does that mean, right? Something you need to understand is that this data is based on closed sales. Closed sales are a look in the rearview mirror, approximately 6 weeks ago. And so when you see this number go up, what this number tells me is there is a difference between what sellers think the market is and what buyers are actually making the market at. So, if you're a seller, the reality is you can ask whatever price you want for your house, but what's going to determine what it sells for is really a ready and willing buyer. So when you see this number go towards back up again, like it has done, that tells me that there was a bit of a bump in demand that sellers didn't necessarily see coming. And that's why buyers were suddenly back to paying towards 100% of that list price. But again, this is a 4 to 6 week ago look in the rearview mirror. If we look at our days on market for new contracts, that has steadily crept upward, but that curve, right, is like centering around 50 days. Is that higher really than we've seen? Yes, unless you count back in August, which was a slow period of time. It is a little bit higher. I think this is closer to what is a normal market, right? Like a normal market is actually over 60 days. So we're a little bit closer to that. I'm not really exactly sure what to make of that. I think buyers today are motivated, but they are wary, right? They don't like getting in bidding wars. They don't want to feel like they're overpaying for the house. They want to wait for the house that they think is right for them. Now, if we look at our three-way chart, right, I cannot emphasize how important I think this chart is, right? Whenever someone is having a discussion about our homes overpriced, our homes affordable, all these kind of discussions, right? I think it's very easy to get stuck in anecdotal data, right? Like my friend who's been working really hard, can't afford to buy a home, which is terrible, right? And not always necessarily true, but you can't go by the anecdotal data. What we've really got to look at is that relationship between buying and selling and the consumer price index. And I think if you take a look at this, one of the things that you see is, believe it or not, buyers have actually been getting a lot of relief on mortgage payments. They just haven't necessarily noticed it. And I think part of that is human psychology, right? Like buyers will tend to notice interest rates going up and payments going up a lot more than they'll notice payments going down. But I want to identify to you here just some important information, right? This chart is indexed back to June of 2018. That is now 7.5 years ago, which was kind of laughable when we started doing this, right? Like this was much closer in time. That is 7.5 years ago. And let's look at where things are. The CPI, about 130% higher than it was 7 years ago. We had some real bad years in there, but things have eased off a little bit. Okay. If you look here, look at our market rents, right? Our rent index. That rent index is less than 150% of where it was 7.5 years ago. Is that a big increase? Of course it is. Is that a crazy, oh my gosh, houses are, it suddenly costs 3 times as much to live? No, it's not. But more importantly is I want you to look at this relationship between our payment index, which is the blue line, and that rent index, which is that yellow line. We've really seen some relief on that payment front, despite prices holding steady, mainly because we've had these interest rate reductions, right? And we've seen a little bit of softness in some of the pricing. It hasn't really gone up, at least not as much as inflation. And what do you see is you see these getting closer together. And the reality is, fundamentally, that's a bit more of a healthier market for housing. So what is the payment, right, on a median priced home compared to where it was in 2018? Well, compared to 2018, it's 175%. Is that an increase? Yes. Is that a big increase? Yes, it absolutely is. However, I want you to look at that relationship with renting and understanding that these numbers are not nearly as out of whack as one might think that they are, or think that they would be, or feel like they are. And it's that sort of sense of emotional economics, I think, that really is coming into play here. If you look at our prevailing mortgage rates, you can see where were we? We were touching and kissing 7% the middle of the year. Now we are firmly in that low sixes, right? And the reality is, if you're willing to explore things like 7/1 ARMs, you can really be in the low fives for things like that. One thing I want to share, right? If you're in, especially Orange County, or really anywhere in Southern California, if you have an opportunity to see an economist by the name of Chris Thornburg, any of his presentations. He does a lot of presentations to chambers of commerce. I really think he's probably one of the smartest economists we have that covers our local area. I think he's very innovative and thinks about economics not only in the purely academic sense, but also in the sense of psychology and understanding how things and narratives really shape our view of where we are economically versus where we really are, right? Some of these things are real. Unemployment going up is very much a real thing. That's not made up. A perception of everybody struggling, that one can start to veer a little bit more towards that psychological economics, right? It's funny, there was a recent study performed and where they asked and surveyed people, and they basically said, do you think people are struggling? And people think the majority of other people are struggling. And then the question was, do you think you're struggling, right? And a much lower percentage said that. So just bear some of this stuff in mind, but also understand that sometimes the psychology can actually start to shape the economics as well. Anyhow, that's all I've got for you. It is December 16th. We are nearing the holidays. I hope you have a happy and safe holidays. I think I'm going to see you just a couple more times. Don't forget to like, subscribe, hit that notification bell. And of course, questions, comments, we love them. And absolutely, if you are someone you know is looking to buy or sell residential real estate in Southern California, we would absolutely love to lend you our expertise in that process and help you make the best decisions. Thanks so much for watching. We'll see you again real soon.